In the space of 1 week, three of Japan's largest automakers reported earnings that looked like battlefield casualties. Subaru operating profit down 90%, a net loss of $100 million. A new factory that was supposed to build electric vehicles, repurposed for gasoline cars. Honda canceled 3 North American EV models and warned of potential losses approaching $17 billion. Mazda pushed its first purpose-built electric car back 2 full years and slashed $5 billion from its electrification budget.
And Toyota, the company that every financial analyst, environmental group, and Western journalist spent the last 5 years calling hopelessly behind on electric vehicles, is having one of its best years ever.
This is the story of how Japan just won an EV race by refusing to run it. Let's go back to Nisen Nifol. That's when Influence Map, a prominent climate think tank, published a report placing Toyota alongside ExxonMobil and Chevron as one of the most influential corporations obstructing global climate action. Not a Japanese auto lobby, Toyota specifically, the world's largest automaker.
The charges weren't without basis. While General Motors was announcing an all-electric future by Nordisen Suwai and Ford was committing $40 billion to 2 dedicated EV plants, Toyota's CEO Kyo Toyoda was standing at podiums warning that EVs were being overhyped and that a premature push to electrification would destroy jobs and overwhelm power grids.
CNBC ran the headline, "Toyota is battling criticism it has been too slow to invest in EVs." Slate called it "How Toyota Fell So Far Behind." The Sierra Club issued a white paper. Public Citizen launched a campaign. Shareholders threatened revolt.
Toyota's response was not to capitulate. It doubled down on a strategy the industry called naive, the multi-pathway approach: hybrids, plug-in hybrids, hydrogen fuel cells, a gradual build toward full battery EVs. The company announced 30 electric models by Nissan Sish while simultaneously pouring equal investment into hybrid and hydrogen technology.
The financial press called it hedging. Critics called it stalling. In retrospect, it was the most precisely calibrated read of consumer behavior in the modern auto industry.
On May 15, Subaru released numbers that don't look like a business plan. They look like a distress signal. Operating profit for the full fiscal year collapsed from 13.6 billion in 2021 to 13.1 million, a 90% drop. In the fourth quarter alone, operating income fell 99.5% to just $0 million. The company swung to a net loss of 13.1 million after posting a $9 billion profit the year before.
What hit Subaru? 2 things, simultaneously. First, US tariffs imposed on Japanese auto imports cost the company 1.4 billion, roughly 1.6 billion in a single year. Subaru sells more than half of its global volume in America. There is no hedge when your core market is also the source of the tariff shock.
Second, EVs. Subaru had committed to developing 4 proprietary electric vehicles, starting with production at its new Oizumi plant in Nishin Nibashi, and when the write-down came, it cost Senbri Luxor $1,100,000 million to essentially admit that this plan was no longer viable. The Oizumi plant will now produce gasoline and hybrid vehicles instead.
CEO Atsushi Osaki said the company was watching market conditions before committing to a new EV launch date. He cited slowing EV adoption in the US and noted that Subaru was paying average incentives of $800 per electric vehicle, roughly $600 more per car than its gasoline models, to move inventory. That's not a business, that's a subsidy program.
3.
What made Mazda's situation different from Subaru's was that Mazda hadn't yet committed major physical assets to EV production. There were no factories to repurpose, no write-downs, no impairment charges. The retreat cost Mazda almost nothing financially because it hadn't yet crossed the point of no return.
Honda crossed it. In March, Honda announced it was cancelling 3 North American electric models and restructuring its electrification roadmap. The potential financial hit near the trillion yen, or roughly 60 billion. Honda is now planning 15 next-generation hybrid models globally, prioritizing North American rollout by the end of fiscal 2016.
In 1 month, here is what is easy to miss if you read the headlines as a Japan loses story. Toyota, the company whose hedging strategy was derided for years, sold just under 5 million electrified vehicles in fiscal Methen Ars Wufdan. Almost all of them were hybrids. By Methen Ars 160% of Toyota's lineup will be hybrid. The company is not retreating from electrification, it is leading it, just not in the way the market consensus predicted.
And the market is confirming the approach. US hybrid sales set a record in the first months of Nissan according to Headlight News. US battery EV market share actually fell to 5.7% in the fourth quarter of Nissan. Hybrids captured 42% of the global electrified vehicle market.
Even BYD, the Chinese EV champion that was supposed to bury Japanese automakers, is feeling the pressure. BYD's passenger EV sales fell for an 8th consecutive month in April, Nissan Niduk according to CNBC, as domestic Chinese competition intensified and export markets proved harder to crack than expected. In Japan specifically, BYD holds just 7% of the EV market and has been forced to introduce plug-in hybrids, the very product format it was supposed to make irrelevant, to compete with local incentive structures.
The Japan factor here is not that Japan was right and everyone else was wrong. It's more specific than that.
Japan's auto industry understood something about consumer transitions that Western analysts didn't want to hear. Large-scale behavioral change is almost never linear. The adoption curve for EVs was always going to plateau, stall, and then resume. Not because consumers don't want cleaner cars, but because the infrastructure, the price point, and the lived experience of range anxiety don't disappear on a policy schedule.
Toyota's CEO, Akio Toyoda, said as much in Nissan Nijuni in terms that Western commentators took as denial. Playing to win also means doing things that others may question, but that we believe will put us in the winner's circle the longest. At the time it read as defensiveness. In May, Nissan Niduk, it reads as a mission statement for an industry that has validated him.
Subaru, Honda, and Mazda are not failing because they tried to make EVs. They're in trouble because they bet heavily on a timeline that the market has not delivered. That's a different problem. The technology was always real. The transition was always happening. But the pace, the specific slope of the adoption curve in the world's largest auto market was wrong. And betting billions on a wrong timeline is expensive.
What happens next is not an EV collapse, it's an EV recalibration. The automakers retreating now are not abandoning electrification. They're buying time with hybrids, a product that Japan happens to lead globally, while the EV market matures to the point where the economics of production make sense without heroic incentives.
Toyota spent years being called the enemy of the future. Right now, it looks more like the only automaker that accurately read what the future was willing to pay for.
The question worth sitting with is this: if the world's most important auto market couldn't absorb EVs at the rate the industry planned for, which other major technology transitions are we mispricing on the same dimension? The timeline risk is often the one that gets ignored.
We'll see how the next set of earnings looks, and whether the companies that retreated earliest find themselves in better position when the market finally catches up to where everyone assumed it already was.